Okay. Good morning. Good morning, ladies and gentlemen. It is with pleasure again that I welcome you this morning for our second webinar in these extraordinary times. I thank all those of you who have shown interest in this BOV MDB COVID-19 Assist Scheme and are participating in this webinar, be they members of the Gozo Business Chamber and all our other guests. Your numerous attendance augurs well and encourages us to hold further meetings of this kind. We have, in fact, another webinar in plan. Daniel Borg, our Chief Executive Officer, will brief you about this at the end of this meeting. We obviously have to start looking to the future. Our members, GBC's members, have participated in a survey where they were given the opportunity to suggest strategies and policies that will shape the Gozo we want in the future. In the near future, in the post-COVID period, the result was what we have called the post-COVID-19 strategic and policy document, which has been presented to government, and the presentation of some of its highlights were given by our participation in the first meeting of the Parliament Standing Committee on Gozo Affairs on the 5th May. The COVID-19 pandemic has hit Gozo hard. You do not need to be an economist or a financial advisor to understand why the island of Gozo is faring much worse off than mainland Malta in this pandemic. Being dependent for 50% on tourism as the backbone of its economy, Gozo has suffered and is suffering a mortal blow with no sign of reprieve in sight. As I have stated elsewhere, these are moments where we have spent and are spending a lot of time on the phone, writing emails, communicating by Skype and Zoom to hear about the plight of our members. It is a blow of unprecedented proportions where the unknown and the uncertain have taken lead and where business people have never felt so insecure. It is the time when, to quote from a Eurochamber recent declaration used in the introduction of our strategic and policy document, I quote, "Chambers of Commerce and Industry are closer than ever to their members during this crisis and recognize their responsibility to help them recover from the dramatic and ongoing economic slowdown." Unquote. It is within this context of closeness to our members, of recognizing our responsibility on making statements on their behalf, that the Gozo Business Chamber has made claims and is still making claims with government to act timely and in an incisive manner. We made our own recommendations. We reacted vociferously to government's various announcements when we deemed that the action taken was lukewarm, and lauded government's intervention when we retained it was bold enough. The subject matter of our webinar today is very important for our business's comeback from the havoc wrought by the COVID-19 pandemic. Access to finance is needed where financial income has vanished, and this, by nature of the circumstances we are living, has to be affordable. Malta Development Bank on Friday, 3rd April, announced the COVID-19 Guarantee Scheme. That was a very bold and positive move in the circumstances. The European Commission, that had been strict in its state aid concessions up till that very same day, relaxed the regulations in the temporary framework, enabling member states to grant much more than had been originally envisaged. Government then announced an interest subsidy scheme that enhanced the COVID-19 Guarantee Scheme on the 16th April. This is what we'll be effectively discussing this morning. As we have always stated since the start of the pandemic, extraordinary events require an extraordinary response. And this is what the Malta Development Bank and Bank of Valletta together will be according to companies who are suffering because of COVID-19. You will hear the COVID-19 Assist Scheme is a generous product that is needed in these momentous days. The Gozo Business Chamber has also set its goals on our island's speedy recovery. The strategic and policy document, which I mentioned earlier, centers on various proposals, but concentrates mostly on initiatives in the green economy and digitalization sectors. This is in complete sync with what the European Commission has just stated last Friday in the amendment to the temporary framework for state aid measures to support the economy in the current COVID-19 outbreak. I quote, "The green transition and the digital transformation will play a central and priority role in ensuring a successful recovery," unquote. Government support, together with the backing of institutions like the Malta Development Bank and Bank of Valletta, will help us achieve what's best for our island. Let me conclude by thanking Malta Development Bank and Bank of Valletta for supporting our webinar. Thanks are due to Professor Josef Bonnici, Chairman, Malta Development Bank, and his staff, who have worked strenuously in the development of the product being offered, and for his contribution in setting up this very much needed institution in Malta. We are also grateful to Mr. Albert Frendo, Chief Credit Officer, Bank of Valletta, who leads the credit arm of the bank and who is known for his practical outlook, so much needed by our businesses in these fateful days. I also need to thank our CEO, Daniel Borg, and Richard Gregg, who together have organized this webinar. I leave the floor to Prof. Josef Bonnici, Chairman, Malta Development Bank, who will now be addressing you. Again, we thank you for being so numerous with us this morning, and we look forward to meet you and see you again in other webinars. Thank you and keep well.
Thank you, Joe. I think you can hear me now.
Yes. You're on.
It's always a pleasure to have the opportunity to discuss and expand a bit and answer questions on these various schemes. It is, as you've said, a very difficult time. It's a unique situation. We have not had this kind of slowdown or stagnation, basically, in economic activity, probably since the Second World War. So we are in uncharted territory. Today, I'd like to start off with a few slides. I'm not sure how I get the slides moving, but there must be a presentation.
Screen sharing.
Screen sharing.
Yes. For the button on your left.
Okay, 1, 2, 3, 4. There it is. Screen sharing. Okay. So I'm sharing my screen. Can you see the slides now?
Yes, we can. Thank you.
Okay, I'll go to the full screen. So basically, the structure of the two schemes we're discussing today have two parts to them. They both required clearance from the European Commission. The first one, the guarantee scheme, the clearance was obtained on the 2nd or 3rd of April. The second one, we are hoping that it will be completely cleared soon. We started discussing this scheme as soon as the government decided that the Development Bank should be the institution taking care of the scheme. The way these are structured is, first of all, that the government guarantee of 350 million to the Development Bank is leveraged up by more than 2 times into working capital loans to businesses. And then on top of that, there is another 40 million that has been earmarked for the interest rate subsidy scheme, which basically involves 2.5% on the first 2 years per year on the first 2 years of the loan. So this provides a significant boost to access to bank funding. Of course, the intention is that the risks are also shared a bit by the banks, as the next slide will show. We are basically covering 90% of each working capital loan. There will be, of course, a great scope later on for Mr. Albert Frendo to discuss a little bit more the details of what that involves, what goes under working capital and so on. Basically, we are covering 90% of each loan that is granted by the banks. There are some conditions which were placed by the Commission, mostly due to state aid rules. As you know, we have to observe state aid rules, otherwise any aid granted will not be of much purpose, because it could have to be returned if it doesn't satisfy state aid rules. That's the rules that we operate under within the EU. So basically, the guarantee scheme covers 90% of the risk of each transaction until the portfolio that the bank is exposed to, the default rate reaches 50%. Now, this is an extremely high default rate. Before the crisis, the default rate was about 8%. What we're talking about is, in other words, loans to businesses that go bankrupt. That is what basically becomes a default. So even if we try and stress test this, as we have done in a recent study, a paper we have been preparing, by assuming very extreme conditions, the 50% even won't be reached. It would be more like 99.9% probability of reaching the 40%. So we're talking about a very significant protection for the banks. After 50%, the banks will face increasing exposure. But even if the losses are at 60% of the portfolio, the banks will still be covered just around 80%. So it's only if the whole portfolio of loans by banks defaults, then they will be covered only about 45%. So that is the extreme scenario we're talking about. That is obviously not a thing that is likely to take place. Otherwise, all businesses will go out of business. And we don't think this is the case. This is a temporary crisis. The crisis will pass. Not at one go, but it will pass, especially as soon as a vaccine is developed and is available, so that tourism starts flowing again and other parts of the economy starts working again. So, when you look at this kind of crisis, within the next maybe year or two, things will start coming back to normal. But in the meantime, we are stuck in this very strange situation. The guarantee scheme and the interest rate subsidy scheme provide significant benefits. First of all, as you know, when there's a crisis, banks have also a responsibility to their own shareholders, which is to, and they are required also by the regulators to ensure that they do not fall into difficulties. And therefore, banks normally become more reluctant to increase risk, especially when businesses are not performing very well. So the guarantee scheme is critical in ensuring that the banks can lend and at the same time reduce their risk significantly. It is not the intention of the schemes under the EU that banks will not face any risk at all, because then that could lead to an unhealthy situation where one is using somebody else's money without any risk in the game, in the process either. So there is always an insistence that there is some risk being carried by the banks. In other words, banks have to do their due diligence. If a business was already in difficulties last year, then there's a problem, because the question becomes whether that business can survive. And there's a definition of what a business in difficulty is. In fact, the Commission imposed this on the scheme, that we cannot provide working capital to business that can be technically classified as in difficulty at the end of last year. But these are details that one can discuss later. There are lower collateral requirements. So the collateral requirement is actually on a portfolio level. So it's not on each individual loan. It is much more flexible. There is also a moratorium period on both capital and interest of 6 months to 1 year. So no repayments need to be made. There's a longer repayment term from 4 to 6 years. And there's, of course, a lower interest rate that is available. In fact, we've calculated so far that from the banks that have already joined the scheme, the benefit is already of around 2.4% compared to previous level on similar facilities. And as I said, there is this, in this case of the BOV, I think, but I'll let Albert talk about that. And there's the subsidy, so that only 0.1% needs to be paid. And we've also, and equally important, I think, discussed with the many banks involved, heavily discounted bank charges, often waiving of processing fees, administration fee, commitment fee, and early repayment fee, and so on. This is not standard across all banks. We tried to negotiate as much as possible, because we are required to ensure that the benefits of the guarantee scheme are passed on to the beneficiaries. But of course, banks have different structures and different approaches. And at some point, one has to trade off between a bank joining in and keep on insisting that certain things have to be reduced. But overall, we are pleased with the results so far. Banks, as I said, are also risking a bit, either at a transaction level of 10% or at a portfolio level, should the unthinkable happen and you get so many businesses going bankrupt. And that will cause, obviously, a bigger exposure given the structure of the scheme. The amounts, we have also negotiated recently an increase in the maximum amounts. So these have gone up from 4 million to 10 million for SMEs, and for large enterprises from 8 million to 25 million. There are some conditions on this, double the last year's wage bill or something else, which I will not go through myself. But this will be explained later. There's also this interest rate subsidy that we have discussed, that I have mentioned. So basically, we are operating under the temporary framework of state aid measures that was issued by the Commission recently. And, we have had a very sometimes detailed discussions and negotiations on this. And the terms we've managed to get are, I think, pretty good. Initially, as you know, with state aid rules, when an entity like the MDB offers a guarantee, it needs to apply a guarantee fee. So it reflects the benefit of that in the form of a fee that it charges. We initially were of the opinion that given the crisis, there should be no guarantee fee. And we had agreed with the government that there would be this approach. But the Commission, in its temporary framework, said that this is not allowable. So in essence, we had to negotiate a reduced guarantee fee, basically, and we managed to do this, so that for SMEs, it is only 0.15% on 4-year loans. And it is a bit higher for the 6-year loans. mostly because that's the structure of the temporary framework, where the longer the term, the higher the guarantee fee that the Commission wants us to introduce. There's also a very important issue on which requires the de minimis issue, so that firms can avail themselves, firms that are already maxed out on state aid under other regimes, such as the de minimis, can still avail themselves of state aid under the COVID guarantee scheme and the interest rate subsidy scheme. And when it comes to the interest rate subsidy scheme, businesses can avail up to 200,000 in aid under the de minimis, plus up to 800,000 under the interest rate subsidy scheme. So that is also an important benefit, I think. And then there's the interest rate subsidy scheme, which I don't need to go through all these details. I think you are very familiar with what is involved. The idea was to provide a one-stop shop so that the guarantees and the interest rate subsidy come in the same package, basically, as much as possible. And this is the way we have structured the program. We have basically right now concluded with 6 banks. Bank of Valletta was one of the first. They are very experienced in this area of guarantee schemes. They've been operating the Jamie and Jeremy schemes, and also the SME Invest, which we have introduced with them. And I must say that had been going very well last year, and is still available for investments, because this program is limited to working capital and not for new investments. Of course, its conditions are very favorable, and the new investments should go under a longer-term program under the SME Invest scheme. So we have APS, Bank of Valletta, the FCM Bank, Isola Bank, MeDirect, and today Lombard Bank joined. We have a couple of other banks, at least, that are very close to joining. Banks have different processes for their approval. Banks are also required to sign 2 documents with the Development Bank. One is a risk-sharing agreement. These are legal documents. It's important not only for us, because we are talking about big amounts of money, and these are public funds, but also for the banks themselves to have legal clarity on what is appropriate and what they can have a legal right to and what not. So this is a over 100-page document, the risk-sharing agreement, and in general, we do not have any big problems with the banks. And then there's a service level agreement, which allows us to get the information that we need to make sure that the structure of the scheme is being followed as agreed. And it's also important. So it's a necessity for us. It's a requirement on us by the Commission, and we could be audited on what the banks are doing. So we have the responsibility to ensure that the banks are following the rules. So if the banks don't follow the rules, we are also in trouble, because we need to have a system which allows us to check on that. Okay, that on my part, that's all I wanted to say. Of course, I will be available for questions and answers, as well as my team. I will now pass on to Albert Frendo, who will give a more detailed presentation on the product that the Bank of Valletta is presenting. I hope you could hear me properly, and because all of a sudden I saw a sound unmute button, but
No, you are okay.
Okay, thank you.
So we pass the floor to Mr. Frendo, who will continue with his presentation. Thank you, Mr. Bonnici.
Good morning. Good morning, Gozo, as they say. It's always a pleasure speaking with the Gozo community. Obviously, because when it comes to the element of strenuous effort, obviously, to go through economic downturns, Obviously, the Gozitans always have to push a bit more due to the unfortunate insularity that comes with the geography of the island. And we really appreciate, obviously, the challenges that the Gozitan entrepreneurs face over and above Malta, mainly because of the concentration of sectors dependency with tourism, which was most hardly hit. And in this situation, this pandemic, which obviously affected Gozo much more than Malta, because of the dependency on external and internal tourism. But as obviously the professor said, one needs to remain positive. One needs to believe that this is temporary. Obviously, how much temporary it is, it's always a big question mark, and that is the risk and that is the challenge. But ultimately, we need to believe that this is temporary, and obviously we take the necessary actions with an expectation that we will go over this situation, because otherwise, definitely we will be talking about different measures how to address this situation. In fact, rather than talking about catastrophes or economic downturns, the language that is being used mainly is the new normal, in the sense that yes, life has to go on, businesses have to go on, but we need to understand, we need to accept that this we're going to work differently in the future. Some still believe that is even the way our practices will change temporarily and go back to our usual self, what we used to do yesterday. But I think that those people who are thinking in this way may be in for a surprise, because of this. I strongly believe that the changes that are going to happen will have a much more lasting effect. In fact, I always bring the example of September 11, 2001, when again, obviously, something hit. In this case, it was terrorism. It was a tragedy that hit particular airlines and particular countries. But then the word new normal was also being mentioned, and I personally, 20 years ago, didn't have any clue what the new normal is going to be look like. But now, look, 19 years later, almost 20 years later, the way we travel has changed radically because of one particular event. And this is another particular event which is going to likely to change our work practices, our use of technology, the way we plan, the way we interact, our value proposition with our customer, the way how we integrate safety, consumer safety and consumer health as part of our product offering, the change in behaviors, the use of the internet, and the use of our resources, the way of our occupancy. There are benefits for sure, the way probably we're going to see lower occupancy costs, because you can use your resources better through technology, not necessarily from the office. In any way, it's still a transitional period where consumer confidence needs to be built, a transitional period where our practices are changing. But I recommend, obviously, to the wise entrepreneurs to look at this situation not only as a huge challenge, which it is, whether we like it or not, but also an opportunity. And on this, I will speak a bit later at the end of my presentation, an opportunity to move on, move ahead, leave as the words say, carpe diem, leverage the situation and obviously turn that to your own benefits. Why I'm saying all this, obviously, when we're talking about financing scheme, because one element in all this, as you rightly know, is liquidity. While profitability is important, and we talk a lot about profitability, the primary aim nowadays is not to be profitable, but to remain liquid. So you see, for instance, shops opening, and when I speak to them, obviously their wording is, if we break even, we're happy. But at least our presence is back in the market. Customers, again, know that we are there to serve them. And obviously, we are managing our stocks rather than keeping them in a dark room. But ultimately, the key driver to ensure that is liquidity. Prior to seeking liquidity, however, you need to restore liquidity, you need to protect your liquidity, and then comes about by obviously using this situation to prioritize what to spend. I think it is a very excellent opportunity, because when obviously the economy was doing well, people tend to spend more, not spend more in a good way, but sometimes we tend to spend more and just destroying value, in the sense that we're spending without having the proper return on our investment. Now is the time to literally go into your expenditure and address it, and ensure that what you are spending is really the amount of money that is giving you value. And obviously, what gives you value, when you see that you need to ensure that you're protecting your resources, your human resources, which is the most important, your technology, your occupancy, those are resources which help you obviously to provide the service in the medium to long term. And obviously you can try to go ahead with overheads which are unneeded, overheads which you are spending because you didn't give, as long as the money was coming in, you didn't give much attention to this area. Now it is the time to really to ensure that we go through this difficult phase and to ensure that not penny wise pound foolish, but obviously taking care of the pounds, obviously to ensure your going concern. So my key messages obviously is that the first thing that you need to do is really prioritize what to spend. Following that, obviously, you look at the intermediaries, the banks, to support you in your way to ensure that in the coming 6 to 12 months, obviously, you can go through this period relatively unscathed. Everyone's going to be a bit bruised. That's the reality. There's no turning, beating around the bush about this. Obviously, we are in an economic downturn, and demand has fallen. So whatever you look at it, in most of the cases, people are going to suffer in their profit margins and their returns. But at least if we take the right measures, we can pass through this, and the sun will rise again. I don't have any doubt about it. When you go, we go now to the schemes in general. Obviously, as Professor Bonnici has explained, practically for every facility there is a 90% government guarantee. So for every 100 euros that the bank will lend, obviously there's going to be a 90% guarantee. Subject that out of the portfolio, if more than 50% default, then that is the risk of the bank. So for example, the bank lends 100 million and more, it's on a first loss basis. So if the bank first loss basis, so if the bank suffers 50 million, that is a guarantee. There's a guarantee of 90% of those 50 million. On the remainder, that will be the risk of the bank. What I need to emphasize, however, and this is very important because there where you see the bank's position, is that this isn't, I have to start and saying it immediately, because we have a responsibility, because ultimately there are three stakeholders in this. First of all, it is the government represented by MDB, but ultimately it's taxpayers' money. So there's a huge obligation to ensure that this guarantee is protected as much as possible, because if this guarantee is burned out, if I use the right words, actually we are burning out taxpayers' money, and no one wants to burn out taxpayers' money, which have been collected and collated over the years through hard work, through a booming economy, and obviously no one wants that what we have built over the years we just burn it in a 6 months period. So there's a huge responsibility, obviously, to protect that guarantee. Secondly, the banks are also stakeholders. So for every facility, if the bank at the end of the day, when you deduct the guarantee fees and whatever, end up with a return of say 1-2% or whatever, every bank has its own obviously return criteria. Against it, the bank has a 10% exposure, which in all probability that will be unsecured. So the banks really need to do their homework well, because obviously if for every transaction they lose 10% to earn 1%, you're all entrepreneurs and you all don't know the sums. Obviously the scheme won't work. So really and truly, the scheme needs to be underpinned by businesses who have good fundamentals, but yes, they are facing their particular challenges. The third stakeholder obviously is you, the entrepreneurs who are borrowing money. The issue, these are not grants, you are borrowing money, and because of your borrowing money, you need to ensure that you have the capability to pay back this money in better times. So obviously the scheme seeks to make it the facilities as available as possible with the best terms possible. But I need to underpin that these are loans, and whenever you run loans, you have a commitment. And if you're borrowing against losses or against costs, and because revenues are what they are, that means that obviously you cannot, when you have to pay back, you're going to pay back from future profits. So the key word obviously is that you need to borrow, because if you don't borrow, you might die, but then you need to give the right medicine. You need to borrow as much as you need. It's not a question of under borrowing, it's not a question of over borrowing. It's a question of borrowing to the right level that you require when you project and take certain assumptions, and that is obviously where the challenge lies, because the assumptions we need to say assume a 6 to 9 months period or whatever. You cannot assume that this is going to go for 10 years, for example, because obviously then all the dynamics will change. So the assumptions needs to be reasonable, but the assumptions are underpinned with the information that we know today. We don't have any crystal balls. We don't know how this is going to pan out. Obviously, what we are seeing is that there is a fight, obviously a fight to preserve human health-being on one side, but also to preserve businesses on the other. And that is creating a lot of tension. If you're looking, obviously, following what's happening in Europe and what's happening in all the world, practically USA, another good example, where there is this internal fight of obviously ensuring that businesses don't die, but obviously also human beings don't die. And it's not easy to find the right balance. What is positive about this scheme? Every company is eligible. So here, well, before we used to talk about SMEs, this covers both SMEs and large enterprise. And also very positive, it's not just every sector, but it's eligible. As before, because of state aid, whatever, certain sectors like agriculture, fisheries, transport, weren't used to be included because of state aid rules and complexities and the EU Commission rules. This has changed because of this temporary allowance, obviously, to put aside to a certain extent state aid rules. All the sectors are available. So when it comes to gaming, transport, agriculture, fisheries, real estate activities, only those are excluded are the obvious ones, obviously, unethical and illegal activities, experimentations with human beings or animals, those environmental, those activities which do major environmental harms. I can assure you that 99%, if not 100% of the sectors you're involved in are eligible. The only exclusion, and this is a very important one, it is that what is called undertakings in difficulty. There is a clear definition. It's GBER. If you look at it on the internet, and we can share it, obviously, GBER December 2019, where there's a definition of undertakings in difficulty. Basically, it boils down to your capitalization of your entity. So if you have a negative equity, or else you have a positive equity, but your reserves are more than your reserves are negative reserves, and then more than half of your equity, there is a big problem in the sense that you are excluded, and there is very limited ways how to address this, because this exclusion comes from the EU Commission, and as I said, it is set in stone, so it's very difficult to go around it. But obviously this is something we discuss, we check, we touch base also with MDB as necessary to ensure whether you are eligible or not eligible. So in conclusion, what I'm saying here, that basically all the sectors are eligible, basically all the entities are eligible, but then if you are undertaking in difficulty, and undertaking in difficulty, there is a clear definition of what is undertaking in difficulty. In a nutshell, very much depends on your equity base. That is the area where there's certain challenges. There are exceptions. Say if you are a startup less than 3 years, there are exceptions. But in general, and this is a guidance I think for the future, especially those entrepreneurs where they have this idea that obviously because of cost or of charges to try to keep the capital as low as possible. The world has changed. The world has changed not because of COVID. The world has been changing for quite some time, and the banks have been changing for quite some time, whether we like it or not. And nowadays, more than ever, it's not just a question of you enter the bank and through a handshake you take borrowing, although obviously there were merits in the trust element underlying that handshake. But nowadays, more than ever, there's much more emphasis on your face of your entity, and that face is reflected in your balance sheet practically. And I recommend strongly those people who are listening to me to have a chat with their accountant, obviously not because of this scheme, but as a going concern for the future, to ensure that the companies are well capitalized, because when companies are well capitalized, the importance of capital, you don't find it in good times. In good times, everyone lend you happily, but in difficult times, it is these companies that are well capitalized and with an acceptable gearing that have a much higher probability to survive. I forget to use just a minute. I think a very important element at the end of the day is what is eligible, what's on the table, if I have to be blunt, in the sense that if you need 500,000, if you need 400,000, whatever you need, how can you build up a case with the banks that you need that amount? As it was explained, the important thing, the message is that this is a working capital facility. Here we're not talking about project finance, we're not talking about asset finance, we're not talking about capital investment. Here we're talking about working capital facilities, and we all know what working capital facilities are. Working capital facilities are debt lubrication. That's why in my first slide I talked a lot about liquidity, debt lubrication that you need to ensure that you are able to operate. And what is debt lubrication? Obviously, the first and most important things are your employees, so your wages and salaries, and those are eligible, including social, health security payments, whatever. Your wage bill, your salaries bill, that is critical, and that is the number one eligible cost under the scheme. There are obviously other costs and overheads, not the least, lease, rental costs, energy and water, fuel, etc. Again, everyone knows that these are working capital drivers and these are eligible. Again, stock, you need stock, you need material for the business acquisition, for the business continuity, and if you manage to trade or you need material or whatever, obviously, this scheme allows the acquisition of materials and stock to continue the business. There have been cancellations, there have been postponements because of COVID expenses, and with them there were expenses. Again, those are eligible. The only exception is if there were penalties and other liabilities incurred due to non-performance, those are not eligible. So it's just more the costs rather than the penalties that are eligible. Maintenance costs, etc. As you realized, I skipped the issue of creditors because I wanted to underline a bit about creditors. Trade creditors are the obvious ones. So any trade creditors that you have or pressing creditors, those are eligible under the scheme. The scheme was a bit wider, and obviously there one can see that the scheme is really earmarked, obviously, to assist entrepreneurs to go through these difficult times. And while, as I emphasize that the scheme is not for capital expenditure, however, if you have capital creditors, investment invoices related to capital credit, but there are two key provisos that these were committed before 2nd April. 2nd April was when the European Commission obviously approved the scheme. So this has to be before such approval, before 2nd April. And there isn't direct financing against them, so you don't have a particular loan against them. Yes, you can include them as well under the scheme. The important thing is that this is the only proviso where we need to see the physical documentation. Let me put it clear. Obviously, the banks have the right to seek any documentation that they feel appropriate. But in the case of this particular clause, this particular eligible cost, it is the agreement that we have with the Malta Development Bank that clearly specifies that when it comes to investment expenditure, we need to see the physical evidence. Now, the word physical evidence in this COVID thing, it's another new normal. So the word physical, it also comprises, obviously, electronic documentation. And one has to see how the physical documentation is acquired without obviously putting in jeopardy the health of the employees and the health of the entrepreneurs. So for sure, we're going to seek for electronic evidence, then when it comes to physical, one has to discuss accordingly. But in a nutshell, the message is that we need the documentation to show that there's evidence backing such investment expenditure. Another interesting area is the interest element related to listed securities. Till a week ago, that was excluded, but obviously, as this is something which is evolving, realities are evolving every day, and no one is interested to see that the securities market obviously go into difficulty because of COVID. So anyone who has a bond, obviously, that is eligible. I need to underline, being eligible doesn't mean automatically that the bank is going to entertain. Obviously, every bank has its own risk parameters. Every bank has its own internal assessment. So ultimately, banks obviously have the prerogative, because ultimately they are sharing in the risk, to decide what to finance and what not to finance. But from an eligibility perspective, at here obviously we're talking about the framework. Yes, interest costs on listed securities are eligible. Last point is on fiscal payments, on taxation, VAT, and NI whatsoever. Those which are due in the period under consideration, and the period under consideration is something that needs to be defined on a case-by-case basis when you do the request. But realistically, one should expect something ranging between 6 months and 12 months. It depends, obviously, on the industry. So if you're a hotel, it's only fair that you say you look at a 12-month scenario, say up to April of next year, because the probability till that time, the activity will be on the low side. Obviously, if you are a shop, obviously, we are seeing some activity there, even though such activity is also being challenged. But what I'm trying to explain is that every sector has its own way of projecting how this COVID is going to impact its profitability. But really and truly, a 6 months to 12 month scenario is a reasonable scenario where one looks into, obviously, to project the expenses. In that case, what I'm saying is that any taxation falling within such period is eligible, and when you have already agreements in place with the tax authorities or whatsoever, you cannot just include all those contractual obligations under the scheme, but those commitments falling within this period can also be incorporated, can also be considered as eligible cost. As regards to loan amount, this has been touched upon from the banks automatically, in the sense that without needing to go to multi-enterprise for authority, they can look at 2 million for SMEs and up to 5 million at large corporates. So those are the limits that the banks are entitled to provide without any further reference to Malta Development Bank or whatsoever. However, for higher amounts, these are still eligible. As explained, SMEs can theoretically go up to 10 million, while large corporates can theoretically go up to 25 million. But there needs to be, obviously, the MDB approval. And the MDB approval, obviously, they look at the documentation at a high level, and they seek a judgment from their own as regards to eligibility, feasibility, or what they consider as the right way from their end to provide such approval. In any case, there are two important provisos to the amount that can be borrowed, and these two important provisos are that no amount that you're seeking can exceed double the wage of last year. So if your wage last year was 1 million, you cannot approach the bank and seek 2.5 million because double of last year was 2 million. However, if that fails, there is the second test, and the second test is, or either or, to be fair, that it cannot exceed 25% of your turnover. So if your turnover is 10 million, then yes, you can seek 2 million, because obviously 25% is 2.5 million. In any case, that both of these tests are fail, in the sense that say that these tests come to an amount between 1 to 2 million, and you need 3 million, the scheme still allows that you make up the case, obviously. The scheme make it clear that now you don't need to look backwards, but you look forward. And how you look forward? Obviously, by you do a proper justification and the self-certification by looking at your liquidity gap. In the case of SMEs, over a year and a half period, over an 18-month period, or in the case of corporates, over a 12-month period, you estimate the cost, and obviously which are the eligible costs, and you have to justify as needed. That's why you need to properly justify. You need to self-certify it in the sense that you need to endorse it and take responsibility of it. And if that self-certification highlights that when you provide these estimates of the expenses, you need 3 million, then yes, you would be eligible for 3 million. So in a nutshell, without repeating too much, we are saying that because this is a very important element, banks are entitled to provide 2 million to SMEs and 5 million to corporates, and the higher amounts they need MDB approval, and the higher amounts are 10 million up to SMEs, the maximum cap, and 25 million for large corporates. But for every amount, you need to do 2 tests to ensure that what you're asking doesn't exceed either double your annual wage bill of last year or double or a quarter, 25% of the turnover of last year. If both fails, you can still provide a proper justification based on a self-certification of the expenses that you need to incur, subject that they don't exceed the maximum capital, obviously the maximum loan amount, you're entitled from an eligibility perspective for such amount. Here I need to do a proviso, and very much ties in with what Professor Bonnici was trying to explain, how the portfolio works out. As I said again, this is not a question of money for the grabs, in the sense that banks have a very important element in ensuring diversification and spread as much as possible over a number of customers. Just to put an example, if a bank decides to have a pot of 50 million and one customer comes and seeks 25 million, out of that 50 million, I'm saying extreme, so just for you to understand, that means that one customer will make up 50% of the portfolio. If that customer goes belly up, obviously that means that any additional exposures that the bank has taken, basically they are the risk of the bank entirely, and the guarantee won't work because it covers only 50% of the portfolio. Why I'm saying this? So as I'm saying, there's a huge responsibility spread all among the 3 entities, and I emphasize that: government, banks, and you as the borrowers. And one really needs to see that the scheme works out in the interest of everybody, in the interest of everybody interested. What will happen, however, because this is important, in that case, if there is a real need for high amounts, the scheme allows obviously for multi-banking, in the sense that you say that you need 5 million and one bank is prepared to allow 2 million, technically you can approach another bank for the remaining 3 million. Obviously, whether the bank takes you on board or whatever, there are the bank's assessment. It depends how much the bank knows you, how much is convinced on your requirements, how much is convinced that it is COVID related and not coming up from problems of the past, etc., etc. That's the usual assessment. But the scheme allows obviously for the maximum amounts, allows for the scheme for the spread between different banks, subject obviously to the capping that I have explained. Term. We're here talking about working capital. So in most cases, especially smaller companies, we expect that this loan will be borrowed up to 4 years. However, the scheme allows even up to 8 to 6 years, but there's going to be different conditions. First of all, the minimum loan term is 18 months. So the minimum term is 18 months, 1.5 years basically, and the maximum can go up to 4 years or can go up to 6 years, depending on your feasibility of repayment. So when you sit down with when you virtually sit down with the bank representative and you go over the numbers, if it's clear that to pay that amount you need a 6-year term, then it has to be a 6-year term. You cannot shift or move around between 4 years or 6 years. Once there's a decision, because again of state aid rules, if you decide to tie in with 4 years and on the 4th year you're facing problems, You cannot simply shift to a 6 years. There's going to be repercussions also because you're going to default. So it's very important, very critical that at this design stage, if I call it, when you are obviously sitting down with the bank to decide the term, you really get it right. There is, as I said, and I will explain, there are going to be implications related to the term, mainly the guarantee fees, but it is important that you opt for the right term, and because if you are over ambitious and you face problems, then obviously there's going to be repercussions. What I can say from the BOV perspective, we're not going to charge any early repayment fees. So if you, at the end of the day, you decide to pay earlier, good luck to you. Obviously, that is a question that you're going to save interest. But as I said, one really needs to design the application well to ensure that you have the right terms. As regards to moratoria, automatically you are allowed a 6 months moratoria, both on capital and interest. So the first 6 months on the loan, there's going to be zero commitment from a cash flow perspective, because obviously the commitment is there. But for the first 6 months, you don't pay any capital and you don't pay any interest. The scheme allows that you can borrow, that your moratoria can be extended up to 1 year. It's on a case-by-case basis, and we need to be convinced that you need 1 year. What we are saying from a BOV perspective was every bank has its own parameters, that on the 7th month we will only allow capital moratoria. We don't allow interest moratoria. To be fair, as I'm going to explain briefly, from the 7th month there will be kick in hopefully the interest rebate. So really and truly, again, the impact of the moratoria over the whole year, if it's decided to go for the whole year, is quite good with little impact. There's going to be some short-term impact from the 7th month, which I will explain. Collateral, because obviously this is one of always the big debate when it comes to collateral, and understandably so. As Bank of Valletta, obviously our emphasis won't be on tangible collateral. We are very much cognizant and sensitive of the circumstances. We are very also sensitive of the time it takes to do a contract, a deed for tangible collateral. We are also very sensitive that it's very important that there is liquidity in the market as far as possible. And we are also sensitive, obviously, that this is a guarantee scheme, and the benefits of the guarantee scheme should be translated into lower interest and lower collateral requirements. So in most cases, when it comes to the 10% exposure, we won't seek a collateral. But I have to make it clear that the scheme allows up to 20% collateral over the whole scheme. So just to put an example, if there is a portfolio of 100 million, then the bank is allowed to take up to 20 million of that 100 million, and the bank can decide not to take collateral alone in one case, take 10% collateral in another case, and take 100% collateral in another case, subject obviously that we respect the 20% collateral. It depends on the risk profile and the customer's commitment. What we're really going to insist on is what we're going to consider as the soft collateral. The soft collateral, basically we are talking about general hypothecs, personal guarantees, pledges, whatsoever. I need to make it clear that everyone needs to understand the responsibility and commitment underpinning the scheme. So anyone who's going to approach the bank really needs to be convinced that he's doing the right measure. The scheme, as I will explain, is attractive from an interest rate perspective, and the scheme could help you obviously not only to go through this period, but also address obviously your working capital requirements. But that needs to be done responsibly, and that needs to be done within the objectives of the scheme and within the risk framework that the scheme obviously is embedded with. So we definitely are going to ask for the general hypothetical, and obviously that will be the whole amount. In case of default, MDB will have will get into the shoes of the bank, and obviously they can pursue the collection of the amounts beyond obviously the payment of the guarantee. So as I said, there are obligations and there are responsibility. When it comes to state aid, as it was very much explained, this is very much to the temporary framework, and the temporary framework obviously ensures that because you are benefiting from state aid, you need to pay something back. To be fair, I think Malta did a very good negotiations here, and I salute here obviously the people who negotiated, mostly Malta Development Bank, in the sense that when you're talking about the 5 to 6 year maturity, the 1 to 6 year, that is the standard guarantee that is expected mainly in whole mainland Europe. So if wherever country you go, you do expect that the guarantee fees if you go for a 6 year period, here I'm talking about table 2, you do expect that you pay 25 basis points. For the first year of your SME, 50 basis points, second and third year, and 1% for the last 3 years. And when you're a large company, you start with 50 basis points first year, 1% second and third, and 2% thereafter. But when it comes to over 4 year period, we were given, I understand, the concession in the sense that comes to SMEs, the guarantee fee is 15 basis points, and when it comes to large all the years, when it comes to large companies, it is 25 basis point. Basis point is a 100 basis point make 1%. So 25 basis point, it's 0.25%, 75 basis point for large companies, second and third year, and 150 basis point, 1.5%. That means in the fourth year. How does this impact your pricing? And then now here I'm going to shift into BOV mode and obviously explain how this is going to be reflected in the pricing that we are going to charge as Bank of Valletta. First of all, this is in the public domain. For the first 2 years, we're going to charge a 2.5% fixed rate. What does that imply in practice? In practice, it implies that on the first 2 years, you're going to be charged 2.5% interest. You're going to receive a rebate of 2.4% interest payment. It means that ultimately you're going to pay 10 basis point, 0.1%. But then, because there's no subsidy on the guarantee fee, because that goes against state aid rules, because state aid rules say that because you're having a guarantee, you need to pay something back. For the first 2 years, you need to pay the guarantee. So if you're an SME going for a 4 year period, as I explained, the guarantee rate is 15 basis point. There's the 10 basis point, which you didn't have rebate upon. So in reality, if you're an SME over 4 year, your cost will be for the first 2 years, it's 0.25%, a 1/4% for year 1 and a 1/4% for year 2. That obviously comes when the rebate comes into play and is reflected. We're looking for a rebate every quarter. So every quarter. So in reality, if you say you took a loan in January, hypothetically, because you have taken a loan in January, there was no COVID. But just to be an example, if you're taking a loan in January, you have a 6 year moratorium. So up to June, you didn't pay anything. In July, you started paying interest. July, August, September. That's the quarter. In October, you receive a rebate of all the interest that you have paid, the 2.4 of it. So you end up with a cost of 10 basis points, and that with top debt, obviously, with the guarantee fee of 15 basis points. So that is how the 0.25% interest will come around. And it is coming both for corporates and for with the table that I already explained, that I have shown in the previous slide, which I'm showing now. So basically, if you're an SME, over 4 year periods, the first 2 years will be 0.25. The effective interest rate will be 0.25%. If you are an SME over 6 years, the effective rate will be 0.35 for the first year and 0.60 for the second year. If you're corporate, obviously, you need to add 10 basis points with the slides that I am showing. This is very important because obviously it shows the commitment and the support to have a fee and an interest rate which should be reasonable in the circumstances we're living in. What is comfortable in the sense from a Bank of Valletta perspective, we tried to remain very sensitive. And if you're an SME over a 4 year period, the rate will remain 2.5%. So from the third year onwards, you'll pay 2.5%. If you're an SME over 6 years, from the third year, you'll pay 2.75% onwards, inclusive of guarantee fee now. So for the first 2 years, they're exclusive. If from the third year, that is the whole price you're going to pay. 2.5 over 4 years, so 2.75 over 6 years, inclusive of the guarantee fee. When it comes to corporates, it is just 2.5 obviously for the first 2 years. Then you go up to 2.75 over 4-year period, or to 3% over a 6-year period. So the maximum rate is 3% over Euribor. The minimum rate is 2.5% fixed in the first 2 years. And in the case of SME, so 4 years, 2.5 will remain variable in the second 2 years, in the later 2 years, but those are the rates. There's a capping of 5 million, and think above 5 million will attract a higher rate of 4% over Euribor floored at 0. This is basically the rate structure. As I said, obviously one can possible, because it's the time for simplicity, it's the time for practicality. First of all, there is from our side there is an application form, which we talk to the relationship manager or the branch. They will provide you, and the application form, basically from it you'll provide the documentation, what entity you are. Are you a small enterprise or you are a large enterprise? And that is very important, because that drives the amount that you are entitled, and it drives the guarantee fee that you need to be charged. And that is critical, that this documentation, this application form is very well filled up. Following that, obviously, there are two key elements. The first key element is to justify the amount, to justify that what you're seeking is eligible, reasonable, and makes sense. And that is obviously by providing us with your 6 months to 12 month scenario of what you're looking at from the bank as regards to the amount that you required. Once you overcome that, the third challenge is to prove to us, to show to us that you're able to repay. And here I do a quick proviso. Here we are not in the science fiction domain, in the sense that we all know the reality. We all know that reality is what it is, that projections are very difficult in certain sectors particularly. So rather than going into a lot of assumptions that could be easily challenged, because obviously your assumption is as good as mine, I think the starting point should be your stabilized EBITDA, your stabilized income pre-COVID. You obviously look at the expected repayments, and then there's the reasonableness test, or I call it the margin of safety, to determine whether your repayment is feasible or otherwise. So obviously this is something where you or your accountants or your advisors can help you with. But at the end of the day, what we need to have is a reasonable comfort on your ability to repay. As I said, the situation is different. If we were looking in normal circumstances, there doesn't need to be a government guarantee. If there's in normal circumstances, we look very much into projections, looking at customer trends, your product, your position in the market, etc., etc. We are in extraordinary times, so keep your projections reasonable. Do projections and where you feel that they are needed. I'm not saying that you don't need to do projections. When you feel that projections are important, please do them. But as I said, it's very important that your documentation is underpinned by logic, by reasonableness test, and by something which you can tangible and you can understand, and obviously build up a good case to see why the bank should provide this facility under the MDB-BOV COVID-19 Assist Scheme. Final point from my side, and I think it's very important, that at the end of the day, I'm going to conclude the way I have started. The loans, the facilities are only a means to an end, and the means to an end is that now is the time not just to wait and hope for the best that this will pass over in 2, 3, 6 months time. I don't know how much, and then we open up again, and everyone is smiling again because the sun has risen again. This is a paradigm shift, that typically Malta and a bit later Gozo are impacted a bit of years after what hits mainland Europe. That's the normality. So if something which is amazing and to a certain extent fascinating is that, for instance, technology usually starts with mainland Europe, and then Malta takes a bit of longer time to adapt to it. But then the Maltese and the citizens, they have an ability not only to adapt it, make it their own, but then we tend to be faster than Europe in the adaptation. And because obviously we are survivors, we are traders, we know that if we don't adapt quickly to the situation, because of the limitations that we are living into small islands, otherwise our future is very much under stress. And this is now another way where the entrepreneurs really need to stand up and be counted, in the sense that not only they seek finance, but they also, it's an opportune time to reassess your business model, you assess your liquidity positioning, you assess your cost containment, you assess your leverage, you assess your structures, your balance sheet structure, your organization structure, your risk management framework, your business proposition. There are a lot of work to be done. Use this time smartly, ensure that your value proposition takes into account the new realities. Customers need to feel safe. Customers, when they interact with you, need to be safe. So your business proposition needs to take into account this reality, which is going to take some time. Reassess your resources, ensure that your important resources are well taken care of, and obviously you ensure that those resources which are destroying value are rid of, because obviously they are not requiring that value that is needed. Ultimately, my message is clear, that we are in a new normal, whether we like it or not. There is fear. It's understandable. I understand a lot businesses, family businesses, who worked hard to arrive where they are now, and they are worried that they're not able to pass to their children a good business that they have built for many years. That is understandable, but please also look at opportunities. There are also opportunities even in these dark moments. Obviously, the opportunities are for those who are able to see them, but I'm sure that's why we are here today, because obviously over the past, you are the people who managed to take such opportunities, and I have no doubt that the Maltese entrepreneurs, Maltese and Gozo entrepreneurs will rise again to the occasion. These are our contact details. Basically, do contact our BOV relationships, relationship managers, our branches, our business centers, the business center of Gozo, our corporate finance, send emails, smefinance@bov.com. Call us, do whatever. We're there to help you. It's challenging. We are overwhelmed by requests because obviously customers are being challenged. But rest assured, we are there to help. We are there to assist. What we expect from you is what you expect from us: reasonableness from both sides, maturity from both sides, and a gentleman or a ladylike approach to address this situation in a mature manner, in a responsible manner. I thank you very much for this opportunity and to address you in this important time of the economic realities of today.
Thank you very much, Mr. Frendo, for a very informative presentation and talk. We will now open the Q&A session, and it will be split into parts. So the first part, we will take questions to BOV, to Mr. Albert Frendo. And then following that, we will take questions to Malta Development Bank, Josef Bonnici and his associates who are also in this webinar. And so please put your questions in the chat window on your right-hand side. I will now switch on also the Q&A session. So no questions for BOV yet. Okay, Joseph is typing.
But there's a question, obviously, what I can answer from a Bank of Valletta perspective when it comes to interest, coupon payments of listed companies. Obviously, I will speak on behalf of the commercial bank. Then, obviously, Professor Bonnici can speak on behalf, obviously, of the position of MDB. The position of the banks, obviously, is that the eligibility is there. So interest on securities, if you have due this year eligibility on if you have this interest on securities and you are looking for the bank to assist, that is an eligible expense. So there are no questions about it in the sense that you can approach the bank to seek finance accordingly. But I need to emphasize that then obviously it is the bank's prerogative to provide such finance or not. When I say the bank's prerogative, because it very much ties with the fundamentals of the entity. Sort of the bank cannot just support a security without being convinced that the fundamentals of that security obviously is going to lead to a repayment of capital and repayment of interest. So if the assessment of the bank that this is, yes, this is a temporary thing and ultimately the fundamentals backing that security from the bank's perspective, which is ultimately a subjective opinion in the sense that every bank can have its own risk appetite and its own subjectivity, then the bank might decide to support or not support. So each bank will have its own risk appetite and its own way of looking at the matter. From Bank of Valletta, we are very, we have taken our position, sort of, we won't be sort of the bank of the last resort, sort of to bail out the listed securities, okay? But obviously those customers with securities where there's a good case where we can support them, we will support them. But it won't be an open door for everyone that obviously anyone who has issued a security and for a reason or another cannot pay the interest, now they can come and knock Bank of Valletta's door and sort of the money is there. It won't be the case. But as I said, when we really believe that the customers has the fundamentals and we really believe in the fundamentals backing such instrument, then obviously we will consider accordingly. So it will be a one-to-one, like any other else, to be fair, discussion with the customer, understanding of the dynamics, and understanding of the business fundamentals, which will lead the bank to decide whether to underwrite that risk or otherwise. And as I said, every bank has its own risk profile and risk parameters, and there's no one bank which has a monopoly on this scheme. So obviously, we as Bank of Valletta, we're doing our best to have an outreach as far as possible. In these last 3 weeks, I never made so much webinars as I did in these last 3 weeks. In the sense, we try to speak with all audit firms, with the Chamber of SMEs, with this is the second time with the Gozo, and with all interested parties. But ultimately, even banks have their own obligations towards their customer depositors. More importantly, I have to say it, more importantly than our shareholders, although obviously I made sound, but our primary responsibility is to protect the depositors of the deposits of our customers. These are, at the end of the day, beyond the taxpayers' money. We are also risking customer depositors, and we're going to do that as we always did in a very responsible manner.
So I have the next question from Joe Borg. So you can go ahead and reply.
Yes. Thank you for regarding the amount capping. There are two criteria: double wage bill and 25% of turnover. Does the amount have to qualify both criteria together, or the amount needed? No, the amount can qualify either or. So I have to explain, because this is a very important question, and thank you for this question. So the amount, it has to be either double the wage bill or 25% of turnover. If for a reason you fail on both, the scheme allows for a forward-looking, and the forward-looking is that you build up your cost requirements, your expenditure requirements for the coming 12 months if you're a corporate, or for the coming 18 months for the if you're an SME. Obviously, you need to understand that. You need to provide your own signature supporting such requirement as an entrepreneur. And if those requirements fall within the eligible criteria, and fall within the limits, obviously. So you cannot make up a request if you're an SME of 15 million, because the maximum is 10 million. Obviously, we will assess that request, but you're eligible for a higher amount if you don't manage to meet those two elements, mainly double wage bill or 25% of turnover. I admit that we expect that 80% of the requirements would fall within those two either or criteria. But as I said, there are exceptions, and the scheme allows for such exception. And if there's a justified exception, why not? Obviously, as I said, the scheme is there to support as much as possible customers who have different needs and different realities. So we cannot do one size fits all. And what does the scheme try to do is, while it has its own parameters, but we try to avoid a one-size-fits-all solution.
So we have another question from Peter Booth.
Would there be an opportunity to make a loan on a new product, which would offer a product to the market which is new, and because of COVID-19? Obviously, there has been market research, which is very favorable, but no sales as yet, and has no financials available, but projections, yes. I'm trying to understand exactly, as you know, obviously, these are unique moments for the banks as well. Banks typically don't obviously lend in such circumstances. Banks aren't venture capitalists. Banks are traditional commercial banks, and traditional commercial banks is that they borrow short term from depositors, they lend relatively short term, they make a margin, and obviously out of that margin they need to ensure that they cover their risks and they cover their costs and their capital requirements. In this case, the risk is high, and there's no doubt about it, because risk is all about certainty. The higher the uncertainty, the higher the risk. So in this question, the uncertainty is very high, because no one in any country came out and tell us, look, this is going to end up by December or by February. Look, we're going to have inoculation, we're going to have the right solution. So rest assured that within 3 months, everything is going to be over. There is a big question mark, and that is why there is the government guarantee. Obviously, and now this question, obviously, from a Malta Development Bank perspective, if the Malta Development Bank perspective, because of new realities, whether being startups or large corporations, they consider that they need to make new offerings, and new offerings will come about due to new realities and through an assessment whether this scheme is meeting the requirements as we know them today, then obviously banks will enroll or might enroll, as we are doing today, and as Bank of Valletta have it. But really and truly, and I think honesty is the best policy, I can see in this particular time that any bank will come out with any product within obviously this environment. So now it is more a question, banks, customers alike, of ensuring that we go through this period relatively unharmed, because even banks, obviously, they are saying they are also going through a lot of pressure in the sense of ensuring that they meet their capital requirements, their liquidity requirements. So every sector is under. There's no sector which today can say I'm better off with the COVID-19. Even sectors which are obvious, let's say the example, the supermarkets, obviously they have their own challenges with their working capital needs, their creditors, their debtors, their ability to pay debtors, their creditors, so which they're having their pressures whatsoever. So really and truly, while obviously some sectors appear to be doing good within the crisis, but I can assure you now from my experience as a banker, when we talk with these people, obviously it's not only the facade that you look, but also the working capital drivers supporting such business entity. And I can assure you that obviously right now, and this is very much evident from the unemployment figures, Malta, thank God, we should consider ourselves fortunate at this point in time. If you look just Europe, USA, even the unemployment trends are very much worrying. This, as I said, is going to create a bit of pain. The extent of which depends how much smart we are in managing the situation, as thank God we are doing today.
We have the last question for Mr. Frendo from Alex Cicluna.
Unfortunately, yes, this is a very legal question, whether you have a GH signed, and whether would there be any to sign for their GH or the previous one cover a new loan as well. I'm not a legal person, and here I will do a caveat because I don't want to answer and then I prove myself to give the wrong reply. My understanding is that we would need to refresh our general hypothec. But to be honest with you, because that is the practice, I don't know, that's why I'm being hesitant a bit, because obviously why that is the practice, I don't know whether the legal framework could allow what you are proposing. What I can say is that following this session, I will seek advice from our legal people to ensure that you have a reply which is obviously the right reply in these circumstances.
Thank you very much, Mr. Frendo. So if there are no more questions for Mr. Frendo, we will publish the first question, which was addressed to Mr. Bonnici. And if you can switch on your video and audio, Professor Bonnici, so you can reply to this question from Michael Gregg. Thank you.
Yes, okay, I think you can hear me like this.
Yes, we can.
Yes, well, part of this question has already been answered by Albert, which relates to coupon payments. This is an additional benefit that we have introduced in this scheme just last week, basically, because obviously there are companies that may have to make payments, and with COVID-19, their revenue stream could be disrupted. But as Albert said, it is also subject to the due diligence of the bank. And this is why, remember that we are operating through the commercial banking network. And the reason for this is because the commercial banking network has the experience to be able to assess projects. We would like them to also not only assess, but also to risk some of their funds in the process. On the possible shortfall of redemption of capital, the scheme, as it stands right now, it doesn't cover this. But I can only say that this aspect is also being explored and examined by the relevant authorities. But the scheme is not. This is not considered working capital. This is an issue of redemption of capital. So when bonds mature and they, in the normal circumstances, they will be rolled over. The question is, are these the normal circumstances that are influencing that kind of situation, abnormal circumstances influencing that kind of situation? So on this, unfortunately, so far, the scheme is not does not cover this aspect, but I can say that there is some work being done, and hopefully there will be some kind of program, but this is more complex than the working capital scheme. That is all I can say on this issue. There was another question which related to new investment that Albert answered to. Can I go to that perhaps?
Yes, sure.
Yes, well, we still have obviously the SME Invest scheme with BOV, and this is for new investment where we provide a significant guarantee of the new investment. However, obviously, it depends on the assessment of the bank. And as Albert said, in the current circumstances, new investment becomes even more difficult to justify. However, there could be cases where it can be justified and the case can be made. And in these circumstances, from our end, certainly we want to encourage new investment. But if the case is viable, the bank has to look at that with its own magnifying glass and to see that the risks involved are reasonable and can be shared between the commercial bank and the development bank.
Thank you very much, Professor Bonnici. So any last questions for MDB Bank? So I don't think so. All right, so I can now pass the floor to Daniel Borg, the CEO of Gozo Business Chamber. Thank you, Professor Bonnici.
You're welcome.
Thank you very much. Richard, are you hearing me?
Yes, we can hear you.
I would like to conclude this seminar by thanking once again our speakers who intervened during the seminar, our President, Josef Bonnici, Professor Josef Bonnici of the Malta Development Bank, and last but not least, our main speaker, Mr. Albert Frendo, Chief Credit Officer of Bank of Valletta. A special word of thanks goes to Bank of Valletta for their support, especially Mark Shikluna Bartoli and Victoria Zoppardi, with whom I liaise continuously on these webinars that we are organizing. This webinar is also being available streamlined on Facebook, and everyone can find it there. Like any other organization, we had to change our way of operating during these times. We managed to organize our second webinar, and we are not stopping here. We received positive feedback on the first webinar, and we also hope that this second webinar has proved useful to you. As you know, it has been an initiative of our organization of offering these webinars for free, even to those who are not part of the chamber. We feel that this is a service that we need to give to the business community in general. In fact, we've already planned our third webinar, so which I would like to share. This webinar will be different. It will take place on Monday at 4 o'clock in the afternoon. During these webinars that we have organized over these two webinars, over these 2 weeks, we try to provide you with information. During this webinar, it will be different. We will see how to deal with the stress which is being caused by this situation. We know that persons in headship and managerial positions have stressful jobs, and at present, due to the COVID-19 situation, the stress has increased and has unique characteristics related to these extraordinary times. Dr. Anton Grech will discuss what is the nature of the stress and provide ways of how to deal with it. I think many of you know Dr. Anton Grech. He's the clinical chairman of the Department of Psychiatry in the Ministry of Health. He has published in international psychiatric journals and presented and chaired in international psychiatric conferences. In 2008, he was chosen as one of the 30 European scientists to be featured in the book Portraits of Scientists and Scientists of Tomorrow, published by the European Federation of Pharmaceutical Industries and Associations to commemorate its 30th anniversary. He's a member of various national boards and commissions, and he believes a lot in using the media to educate on mental health. And for the last years in Malta, he conducted radio and TV programs on issues related to mental health, which broadcasting surveys repeatedly showed that they have a very vast following by audiences. To this end, I would like to invite you to continue following us as we will be launching the official invitation and platform for the registration. As with all our webinars, these are free even to non-members. As a chamber, we feel that we should do our part, and we feel that this is a small gesture that can provide a valid contribution to the local business community. Thanks once again for joining us today.
Daniel, we have another question for Mr. Frendo. In fact, I've made him presenter again.
Yes.
Mr. Frendo, you can share, switch on your mic and camera. Okay.
Just to clarify that we would need general hypothec whenever we need to refresh the general hypothec to take into account the new facility. This is as a reply to yes, the question which has been shown now. I was going to type an answer, but now obviously I have this opportunity and I can confirm that a refresh of the general hypothec would be required, obviously, to take into account the facility in question, which has a specific loan agreement, obviously, tied to the MDB facility. As you know, from our side, there will be a specific loan documentation covering the scheme under the guarantee scheme of the MDB. So the answer is yes.
Thank you very much, Mr. Frendo, for your intervention. So, Daniel, any other comments that you would like to add?
No, just thank you once again. Thanks you, Albert. Albert has really been helpful over these two webinars, and we really thank him. Also, thanking all the speakers, especially Professor Josef Bonnici. I thank you once again. Please follow us. It will be a very interesting talk by Dr. Anton Greg. He's a very good speaker. So thanks Bank of Valletta once again for providing their support to us. And we hope that these seminars are really useful to the business and local community in general. Thanks once again.